The looming Bitcoin deathcross has brought back the worst that phony market analysts and improvised gurus can offer. Time wasting, worthless clickbait fear porn, and quite frankly, I've had enough. So today, I'm inviting you to take a step back, consider this market configuration on a larger scale, and revert to the facts by doing what QuantTake does best: extract quantitative truth out of the market. As always, this episode comes 100% free from all type of price action BS and other related pseudoscientific baloney. So drop the dopamine, turn your brains back on, and let's have the data do all the talking about what this so-called bearish threat really has going for it. Let's go. Quick reminder about the definition of the deathcross before moving on. It is as close as you would imagine to the baseline of what retail trading intelligence has to offer, a moving average crossover. Might as well just flip a coin at this point. The most commonly accepted parameters to define a deathcross are 50 and 200, with a bearish signal supposedly being given when the 50-day moving average crosses down the 200-day. Needless to say, with a system grounded in such a mathematically insightful background, you better make sure that your underlying is as stable and trending as the inverse payout profile of a money market account if you expect to make any money on the short side. Anyway, let's get to it. In order to correctly assess the impact of the deathcross on Bitcoin, what I want is to uncover what happens to the price behavior of Bitcoin once the bearish signal of the deathcross has been given, and until the end of this configuration when the 50-day moving average crosses back over the 200-day moving average, which is also called the golden cross. In more specific terms, I want to know such metrics as how many times this deathcross has occurred historically, the average percentage drop in price for each one, the maximum magnitude of these drawdowns, how long they lasted, and of course, the expected trade outcome should you have jumped on it every time it happened. The scope of our daily time series ranges from October 8, 2013 through January 11, 2022. That's 3,006 daily data points cropped to 2,806 since we needed to use up at least 200 data points to compute both moving averages. Over the period, we can note 6 instances of a deathcross setup. Without any surprise, these instances are relatively stable with no erratic crisscrossing due to the inertia created by the high latency used to compute both moving averages. It turns out that out of those 2,806 usable days observed, the total time spent in a deathcross configuration spans 997 days with an average of 166 days per deathcross, a minimum of 44 days in 2015, and a maximum of 388 days back in 2018. Now here's what happens to the price of Bitcoin during these setups. First of all, retail proves once again to not only be overhyping the fear, but to be totally upside down versus reality. Check this out. Bitcoin deathcrosses actually made money 4 times out of 6 on the long side and yielded an average positive return of plus 9% with outcomes ranging from minus 40.5% to plus 35.7%. Also, the pain to get there is relatively mild since the days spent in the deathcross had you endure an average mark-to-market on your long position of only minus 4.2%, ranging from minus 39.1% in 2014 up to a positive 16.8% in 2020. Pretty quiet for a doom and gloom pattern if you ask me. Lastly, the maximum pain historically registered by Bitcoin deathcrosses stands at an average of minus 29.5% per instance, ranging from minus 63.5% in 2014 to barely minus 1.6% in 2015. All in all, there is clearly nothing to freak out about, and all of that hype seems rather anecdotal and overblown when put in front of actual data. Is this at all surprising? Not in the slightest. Apart from watching social media trading clowns getting all worked up, confronting the specific price motion dynamics of cryptos against high inertia technical indicators should have already given you a no-brainer hint as far as guessing that all the drama around deathcrosses is all nonsense. This barely required any calculation really. I guess the frustrating part here is that to make matters worse, even those overhyped so-called serious crypto channels out there approaching the market with more sense, or so the story goes, still fail to put any data on the table and instead reverted to push more misleading information by stating that the reason why this setup was invalid was because moving averages are so-called lagging indicators, thereby implying that some other price-based indicators are not. All I can do for now is shake my head at this. It's a sad picture really when you see hundreds of subscribers upvoting these videos without checking anything whatsoever. This lagging indicators thing alone will make for its very own video in part 3 of our trading education series, and trust me, I'm gonna go hard on it. But back to topic, let's get practical with the data on hand. Now we know the nature of Bitcoin deathcrosses, how should we trade it? The answer is multi-pronged. You need to keep in mind that the statistical load of this analysis is way too light to draw any strong conclusion out of it. However, mathematical understanding of how crypto prices form and behave puts some weight on the fact that this deathcross technical configuration should remain an opportunity rather than a threat in the long run. The first takeaway here would therefore logically be to earmark some cash on hand to commit to the market on the long side while the deathcross is in play. Second, no matter how much you want to take advantage of the correction, it is important not to jump the gun either. Here's why. It appears that historically, on the very day of the moving average cross down, Bitcoin's daily price closed at an average minus 13.2% discount below the moving average crossing value. So attempting to anticipate the cross by buying above the expected minus 13.2% discount level would likely be foolish. Third, regardless of the average bullish outcome of death crosses, it remains that the market still seems to like to wiggle down quite a bit during the course of this setup. If we remove the outlier from 2015, we end up with an average maximum drawdown of minus 35%. So unless you believe that cryptos are dead, that the dollar is only going to get more valuable from here, and that legacy finance is here forever, you could decide to stack the odds in your favor by taking the safe, middle historical road and beat the market at half the average drawdown, or about 17.5% down from Bitcoin's closing price on the day of the cross down. Alternatively, a more sophisticated approach than leaving a standing buy limit order would be to start beating the market when a reliable technical signal flashes a bullish reversal in order to avoid waiting for a golden cross to occur while still being able to manage your risk should the market reverse and take another tumble. And something tells me that a video is in the works to help you do just that, so stay tuned. As you can see, when you have data and care to look through it, there is no need to have an opinion or thoughts about the market trying to predict it. While no single analysis is going to get you a surefire trade, despite the little data at your disposal, there is always a way to squeeze some value out of it and tilt the odds in your favor, if only marginally. This is what was done today. I hope this video cleared the air on this deathcross issue and especially helped you frame the opportunity where others will only see the risk or will dismiss it as entirely useless. Staying power in this game is paramount, and that's what we strive for on this channel, through math and data only, not chit chat or a talk show. I'll see you in the next video.